Welcome, welcome, welcome. It is so great to see you guys here, and welcome to my investing webinar today. I am so excited to be doing this, and I hope for the next hour that you're going to get a lot of valuable content. The purpose of this session is to give you the tools to invest in the stock market. And I want you guys to have the confidence and certainty to make intelligent investing decisions when you're done here. So it's so great to have all of you. And I will just get started, and we might see that people will come in, but we have an hour together. So let's jump in. My name is Signe, and I'm a value investor as well as heading up a team at the Lego Group. I'm also the founder of Aahus Investing, where I support millennials making confident investing decisions. And my investing style comes from proven experts such as Warren Buffett and Guy Spear. And the reason why I'm doing this is because I read a book that completely changed my life and the way I see investing. So I found this method of investing that creates certainty in my life, and I'm super passionate about sharing it with everyone so that you get to experience the same aha moments of investing, and also to stop my own fear and the fear of making some bad calls and making bad calls in general. So the reason why we're here is that I love my job. I love my job, but I don't want to work until I'm old. I have a dream of retiring early so that I'm fresh to experience the wonders of the world. And if I don't do something, then I'm going to retire when I'm 70 years old. And just the thought of being 70 and traveling the world is not the same as being 50 or 60 and still possibly feeling young doing all of these things. So this is really why I'm so passionate about sharing this investing style. So as I mentioned earlier, the investing style really comes from Warren Buffett, who is an incredibly rich American investor, and he's the most successful investor of the century, with just under 20% rate of return every year since 1960. So that's 60 years. He's gotten 20% per year. And in this same period, the American index that tracks the largest companies in the United States, it rose 7% per year, which is, it's fine, 7% interest per year. You can't get at that in any savings account, so that's pretty good. He made 20, and that's why I think it's worth watching what he is doing. So my mission is to pass on this knowledge that I got from Warren Buffett, and I'm translating it so it applies to everyone, and especially us young people, because he has communicated this knowledge through the years, and I've distilled it into this session that we'll go through today. So my goal with this session is to let you experience the certainty, the confidence, and rewards. And I'm just going to stop sharing so you can see me. I hope you can all see me too. So my goal is that you get to experience this certainty and confidence and the reward of value investing, because this is really my passion project, and I want as many people as possible to know about it. So I have been investing since 2008. Hey, Michelle, thank you so much. It's so great to see you here. I've been investing since 2008 myself, and for many years, I just had no idea, like so many other people, what investing was really about. And I actually tried to find information about investing strategies. I went to seminars, I listened to radio shows and podcasts about investing, and all of these things made me believe that investing was about predicting what a stock would do in the future, what would be trendy, and which sectors would be growing in the years to come. And this is also what I see a lot in social media, and maybe you see it too. will this stock go up? Will this sector, do you believe in nitrogen in the future? But the most successful investor of all times, Warren Buffett, he does not look into trends. He does not look at what is trendy. So for me, I'm thinking, okay, so should I be looking at what everybody else is doing, or should I follow the advice of the most successful investor of all time? So I know my choice, and I'm going to share it with you tonight. So again, I see myself as sharing this knowledge. He has already shared it, it's out there, but it can be a little bit difficult to understand in his language. So I have translated it so everybody can understand. Also, the success I've had with value investing, it makes me a big advocate for this theory, because buying like this has given me a 4-year return of 53%. So what I'm doing is I'm buying businesses at a discount, and that's what we're going to go through today. So I don't guarantee that you will have the same rate of return. It really depends on many factors. And that leads me to just go through a disclaimer. So I'm going to share my screen with you guys again, because I want to just share with you that we are here for educational purposes. Let me try to find my mouse again, so hopefully you can see this again. Also, I just want to share that I had Corona last week, so my voice is not the best these days. So I'm going to drink a lot of water and hope that my voice won't fail on me. So the disclaimer, and I'm just going to read it for you guys, so we're all aware of that we're here for educational purposes. Neither Signe Lønholdt, that's me, Aahus Investing, nor any of our representatives, employees, or independent contractors are in such capacities licensed financial advisors, registered investment advisors, or registered broker-dealers. Neither do they provide investment or financial advice or make investment recommendations, nor are we in the business of transacting trades. Personal trading examples are for educational and demonstration purposes only, and they're not representative of any positions or consistent returns in any account or an expectation of future gains. Neither the information nor any opinion represented by me, Aahus Investing, or any of our affiliates constitutes a solicitation or offer to buy or sell any securities, futures, options, or other financial instruments. You, the trader, assume the entire risk as to the results and performance of the trading methods. So that was the disclaimer, and I need to say that before we get started. Another thing, I would love to know where you all are from in the world. So if you don't mind, please put it in the chat. And I would also love during the seminar that if you see anything that's an aha moment for you, or that you learn something new, or some information that really resonates with you guys, please put it in the chat as well. I would love to know. So please contribute to the chat. And we got New York and Copenhagen. It is so wonderful to see you guys from different places around the world. Canada. Yeah, hey, Julie, good to see you. Fantastic. All right. And Natasha, also fantastic to see you from Denmark. So, value investing is what we're going to talk about today. It's a practice and a never-ending joyful journey. And during the next hour, I'll cover the 4 steps of intelligent investing. And all you have to do is follow these steps. Sahid, great to see you made it. We were just in contact. Great to see you made it. So the main goal for you is to find a wonderful business, a wonderful company. And a wonderful company is a company that you can understand and that is in sync with your personal values. And the company has a competitive advantage. They need to be better than their competitor. Really looking for winners here. And then we want management with integrity and talent. And finally, the fourth step is no matter how wonderful this company is, it's not worth any price. We want to buy it at a discount. We want to buy it at what we call a margin of safety. And I'll revisit that term, but it really means that there's room for error for us. If we made a judgment, a bad judgment, there's some room for errors for us. And these are the 4 steps I will go through in this challenge. But before we move on, Warren Buffett has 2 rules of investing. And I think these rules are really interesting because rule number 1 is don't lose your money. Don't lose your hard-earned money. And rule number 2, never forget rule number 1. So easy to remember, don't lose your money. So value investing is all about being mindful about your hard-earned money and really mindful about where you're investing them. So value investing, it's not about speculating about which stock will be trendy, and it's not about guessing and hoping and wishing and praying and waiting that the stock market will go up. It's about certainty. And like Buffett says, if you buy a wonderful business at an attractive price, you're certain to make money. That's a quote from Buffett. So congratulations for showing up here. It's so awesome to see you guys here because you're getting financially literate and taking this opportunity to learn. And I'm not going to hold back any information here. This is truly all you must know. So I'm going to take a drink here again. So I want you also, for some of you that might be on social media and looking for the next trend, etc., I want you to change that pattern and then stop choosing these stocks you hear about on TV shows or radio shows or social media, and then, do follow these steps instead. So for myself, my own journey into investing was that I was really, really a good girl, and I was saving my money for times of trouble. I always heard, save your money, save your money. And maybe you're the same. You're, saving up for this good, secure life later. So I want you to take a look at this graph. Let's see. Oh, maybe I actually did share the wrong slide deck. Let's see here if, yeah, I did. Okay, so let me just see if I can find the one with the right. Let's see here. Or actually, what I might do, I will go to my website. Sorry about this. So, because I want to show you about inflation and a graph that will show you. So moving this one so you can see it. Right, this graph right here. So what this shows you is that over the next 30 years, $100 or 700 kroners, you guys that are from Denmark, $100 of your spending power, it will be eaten up by inflation and leaving you with around $40. So under half, $100 leaving you with $40. And I haven't even counted all the bank fees and all the, right now the inflation is high. So if you save your money and you think that's right, then your money will be eaten over time. So $100 today will be $40 in about 30 years, where it's just eating off your savings. It's the spending power that just go down. So when I found out about this, it was like, oh my goodness. So I need to find a way to earn more than 3% per year. And that's what you can do in the stock market. And so we want a strategy where we can get more than 3% per year. And as you might remember, I told you earlier, Warren Buffett, he does 20% per year. So he is pretty good doing pretty good there. So during this webinar, I'll be using a checklist, and most of you, I hope, received this checklist in email. You don't need it right now, but maybe after the webinar, you want to actually use this checklist. But I sent it to you in email, so if you didn't receive it, check your spam. You should have it. So as value investors, we, as mentioned, the first step is really to understand the company that you're investing in. So for that, you want to invest in a company that is in your circle of competence. It's a zone of area or expertise where you have a lot of knowledge. And the way you find out about what is in your area of competence is that you can actually draw some circles. Let me check. Yep. You can draw some circles to find out what is in your, and I hope you can see my iPad here. It looks like you can. So the first circle here is what you work with. How do you make your money? Typically, you have an expertise within an area of your work or profession. There, you'll know certain things about this industry you're in that you can use to your advantage. So, for example, if you're a teacher, certain educational programs that works really well, or a certain kind of computer or another equipment that is really great for educational purposes. So note down all the brands and names you know from work that you really like, and add these to your wonderful inspiration list. And then the next circle you want to draw here is where you spend your money. Is there a product or a service you really love to use? It could be a restaurant or an experience. Think about something you really love and enjoy to use, eat, going to, that you rave about to your family or friends or co-workers. And then you need to find the company behind that brand, and then write it on this list also. And then the last circle of competence area here is all about your hobbies. What do you do when you're off work? There might be, if you're running, there could be certain running shoes, yoga pants, anything you use with your hobbies. Write down the brands here and put them on the list. And by now, you should have a list of a lot of different brands or companies that you know of that you really enjoy using. So that is definitely the first step. If there are some areas that overlap, right? Some areas that overlap, you get bonus points because you want to try to find products and brands in this sector first. Don't go chasing it. If it's not like that, then don't worry about it. But by now, once you've done this, you should have a list of some pretty cool brands that you might want to look more into. So the next thing you want to do is you need to find out, is this company listed on the stock exchange? And the easiest way to find out if you can buy shares is to Google the product or brand. First, you need to find out which company produces it. And then you need to find out if it's publicly traded. So you simply just Google it, and then you can Google, for example, iPad, right? It's Apple Public, and find out, is it a public company? So if it's private, you won't be able to buy any shares of stock. And for some companies, they might be public, like the Lego Group is actually a public company, but all the shares are owned by the family. But there are other public companies, most of them are publicly traded so that you can buy them and you can be an owner. You can actually own a small share of that company and be an owner by buying the stocks in that company. So Warren Buffett and his business partner, who's called Charlie Munger, they often mention that they always stay within this circle and they actually never go near the edge. So what they've done is that they have found some patterns in businesses, and when they see these patterns, they always invest in those. And One thing you also want to keep in mind is that you might put a credit card or a bank in your circle of competence, but bank business is really complex. Bank products are incredibly difficult to understand, and even the bank industry might not quite understand what they're doing. And we saw that in 2008 when banks collapsed, that they really did not understand their products. They were so complex that banks collapsed. So banks aren't for you either. But a lot of other businesses might be. So put them on your list. And after you found that wonderful business, then you want to open your checklist here. And in the first part here, you want to write down what you know about the company. So is it something you use at work, or how did you come about it? Is it something you rave about? Just write a few lines so you can remember later. How did you actually come across this company? And then the second thing on my checklist here is that if it actually fits with your values and personal ethics. And that is definitely something that is super important for me, because I want to, through investing here, vote with my money and decide which businesses I want to support. And for some people, this is not super important, but we actually have a chance here to write down how it fits with our personal values and ethics. Warren Buffett, for example, he invests in oil companies, which I assume some of you that's on this call here probably wouldn't do. But Warren Buffett does invest in oil companies. However, he has mentioned in an annual meeting that there was a certain meat factory that it was just not within his values and ethics to invest in that meat packing facility. So he does actually also invest with his ethics and values in mind. And then the last thing on the checklist here, and as mentioned, you don't need to open it. I'll send you the video from this webinar when we're done, and you can download it and have plenty of time going through it later. But the next thing is, what is the greater context? How does the company fit into the world? And what we mean by that is what you think the future holds for this business. And this is not about what will be trendy. If it's only because it's trendy, then you might not have the right business. But it could be foreseeing that it could be risky. You want to think about that in the future. And if we look at the car industry, for example, cars, they're going through a lot of disruption these years, from fuel to electrical vehicles. And now multiple companies are working on self-driving cars, which means that cars that doesn't have all the latest technologies and companies, they're going to fall behind. So I used to have a Maserati, which is a sports car, Italian, beautiful car. I used to have that on my vision board. But with all of these new electrical cars and everything that's happened, that Maserati is actually off this list here and off my vision board. So another thing about the car industry to keep in mind is Uber. That has really also disrupted this. So in the United States and in other countries, it is actually much cheaper to buy and a ride with an Uber rather than having your own car and having to put gas in, etc., insurance. So what you'll see is maybe in some places the people will stop buying cars because they can just take a rent service. So maybe you want to stay clear of this business until they've gone through the change. And Sahid, you mentioned semiconductors. Absolutely, they have supply chain issues, and the car industry is really suffering from those chip issues in the semiconductor industry. And Moore's law, where some companies in the semiconductor industry is just way far behind, way far in front of other businesses like TSM, where and Samsung and other businesses just simply can't go at the same speed. But very, very interesting industry, definitely. So the next step in my checklist, and let's open it again, is management. And with management, we really want to ensure that management has integrity and that they allocate the money in the business with us in mind, with the owners in mind. And you also want to check how much debt the company has. And this is one of my most important things, is really about the long-term debt. One thing is the short-term debt. Look into long-term debt. And you can find that on the internet. Just Google long-term debt. As value investors, we have the mindset of being business owners, and we're shareholders, so we own a portion of this company. So we want to make sure it's a healthy business. In here, it says that the company, please ensure that the company has 2 years or less of long-term debt. And we want to make sure that the company can use their free cash flow, so their cash at hand, to actually pay off the debt and do it within a short period of time. And that number can be found, for example, on stockanalysis.com, but there are many local websites out there that actually shares how much debt a company has, and you might be able to find articles on the topic, so you don't have to necessarily calculate it yourself. In my courses, I show you how to calculate it. It's super easy, but for you guys, you can also easily just Google it. So we want management to not take on this long-term debt, or that it is super low. And the reason for that is because businesses go under when they have debt. Thriving businesses without debt, or even suffering businesses without any debt, they don't go under to the same degree as companies with debt. So that is why it's such an important point for me. Make sure it doesn't have debt. And then the next thing, and here comes in some investing language that is difficult. So sometimes Wall Street loves to make it difficult for us. And I'm going to introduce you to abbreviation ROIC, ROIC in Danish, ROIC. And that means return on invested capital. It just indicates how will management have made profitable investments in the past. ROIC, return on invested capital. Fancy words, just say, were they successful in making investments? And that number can be found in a lot of places too. We want to make sure it's above 10%. The bigger, the better, this number here. Make sure it's above 10%. And again, it's a number you can find many places, for example, in the company's annual report, on Yahoo Finance, yahoo.com, in their finance section, look up the company, and on many of these regional platforms in your own language. I recommend to track it back 10 years to just make sure it's, because especially also during Corona, some companies are doing extremely well, some companies aren't doing well. How have they been doing for the past 10 years? And to find that, there's a website called macrotrends.net, or check back the annual reports. A business every year make a report where they write all of these things. You can track back. There's a search function, search for ROIC. Boom, it's there. But in this checklist here, there's actually a nice little table where you can write it. So make sure to do that. And we're still talking about management, because we're talking about how well they actually distributed the money they had and invested those money. And that was return on invested capital, 10%. So one more thing you want to look into is the CEO, the Chief Executive Officer, the head of the business. We want to make sure that he acts with integrity, and the same as other executive and board members at the company. And the way you track the CEO is try to look on YouTube if there's some clips, some interviews with this person. Look at other media appearances this person may have done in the past. On the company website, you can listen in on some earnings calls, so you can listen to their voice and what are they saying? Are they making sense? And yeah, that can be found, the earnings calls, on the investor relations section of the company's website. You can check their LinkedIn profile, social media sites. So just try to do a little bit of researching on the company's CEO. And then what you want to ask yourself is, where did this person come from before they were appointed CEO of this company? Did they grow within the business? Did they come from outside? Were they the founder? What was their past career path like? Are there many articles or just a few articles? Anything that describes this person and their previous roles. And another tip is glassdoor.com. Many companies, also Danish, Dutch, especially American companies, have profiles on glassdoor.com, and where former employees or current employees rate the company, rate the CEO and management. So check that out. You also want to check the Chief Financial Officer. That's called CFO. And that's also a very important person to do some research on, because we want to make sure that this is a person that has integrity and that they don't manipulate the books, because they are the company's executive bookkeeper. So what have been written about them in the past? Do they have a good track record? And if they didn't, there's probably an article about how they didn't do a good job in the past. So Google is your friend. So Warren Buffett, the next thing I want to talk about is that Warren Buffett and his business partner, Charlie Munger, the team there, they're the most successful investors over time. And you can actually follow what they invest in. Their company is called Berkshire Hathaway. And you can learn from the best in the world and get excellent results and just copy the exact same trades as Buffett and Munger. So yes, you heard that right. You can actually find out what they bought and you can buy exactly what they bought. You have to wait a few months to get that visibility. But a lot of time, the price of that business hasn't necessarily moved a lot since they bought it. That's definitely something you want to check. But there's actually not that many people out there that does this. So the price is usually pretty good still. What where you can find it, what it is called is 13F forms. Again, Google 13F, and they're filed up to 45 days after the end of a quarter. So the next 13F report is coming out in 2 weeks in mid-February. So after every quarter, they come out. On an American website like Whale Wisdom, you can also see what purchases the governmental institution in the United States, SEC, have this information, and you can find information from not only Warren Buffett, but also other funds and value investors like Philtown, Guy Spear, Munish Pabrai, what they invested in the United States. You can find that. And you need to look for their funds, not their names. So just Google Warren Buffett company or fund, and you'll be able to figure out. It's called Berkshire Hathaway. One thing though is, before you mindlessly jump into a stock that he invested in, you have to understand the business. Don't invest in a stock because Berkshire Hathaway invested in it. You must understand it. And how do I know that? Well, I have made the mistake of actually jumping in to a Berkshire investment that I knew nothing about. So in the summer of 2020, there was a 13F filing for the second quarter of 2020, and I saw that Berkshire Hathaway had invested in a company. So I jumped in without doing my due diligence. I did not use my checklist like I'm telling you guys to do. I just jumped in because, ooh, Buffett was in. And then right after I came in, they exited the position. Berkshire Hathaway sold all their stock. And it turned out it wasn't even Buffett that wanted to invest in the stock. He's got other investment managers in the company. And he didn't decide to invest in it, but it was him who decided to leave. And there was many articles on the topic out there. And the price of that company fell, and it never regained the price. So an expensive learning. And next time, I'm definitely going to use my checklist and just check to see, do I understand the business? Is it a good business before I just jump in? But it is definitely something you can use and say, okay, this company, I thought it was pretty cool, and I see Buffett invested in it. That's great. Then I'm probably going in the right direction. Another way you can do is to research with your research is to actually check if any value investors have invested in the stock. And you can go to, for example, a website called Guru Focus, so a guru and focus.com, to find out what super investors are buying. And when you search for your company on that website, you can see who bought into it. If you look at their profile, you can see what is their investing style and find out if they're value investors. And that will give you that outlook. And I'll share my checklist again, because in my checklist, it says moat, which is a funny word, right? So what moat means is a company's competitive advantage. As mentioned before, the company, it must be better than their competitors. We're looking for winners. And Warren Buffett, he calls this competitive advantage a moat. And a moat is the border that protects a castle so that enemies can't take over the castle. And Buffett, by moat, he means that, you know, it's the water that protects a business. It's the competitive advantage that's a moat. So to find a winner in an industry or sector, you need some numbers that will give you that clarity. And one of the numbers is sales growth. And that's the first point here. The company has increasing sales growth year on year in the past 5 to 10 years. In finance, they like to call it revenue, but you know, it is sales. So write down revenue equals sales. And we want to see an increase. And on, for example, Guru Focus, you can also see some of these parameters in a visualization. And in my investing course, the valuation sheet that I have also actually shows a diagram over this growth, because we want to see this increase year over year. And I'm a very visual person, so I like to see it visually. A small growth is fine, as long as it's growth year on year for the past 10 years. So what types of moat are there? And as you can see on the screen, there are some different kinds. Buffett is particularly interested in these kinds of competitive advantages. So he's very interested in a monopoly, for example, a railroad and railway that is hauling coal directly from the mines to the coal burning power plants. This is the most low-cost way of transporting steel and coal. It is much more expensive to do it by truck. So he's got a monopoly here in transporting some of these very heavy things from the mines to the plants. He's also very interested in inflation-resistant modes. And an example of that is a credit card that's called American Express. And they have a business model where the merchants have this payment fee structure that makes it inflation resistant. So he really likes that too. And then the third mode, he likes it what he calls a consumer monopoly. And that's a company like Coca-Cola, where the customers are incredibly loyal to the brand. It could also be Apple computers, for example, where a lot of Apple users are super loyal to Apple products. Apple also could have an ecosystem network mode, where once you're in this ecosystem, it is very difficult to leave. I don't know if you've ever migrated from Apple to another product. It is just very difficult. So some other modes are the patent mode, which is a patent or a secret that makes the company really unique. And it's also a real estate location mode. So where the company has a store or a restaurant or a distribution center in a very unique location that makes the company have a unique competitive advantage over other companies in their industry and sector. So what you do with the checklist is you just simply check that you know which mode it's in. And then the next thing you want to do is that you want to check that it's a winner. And this is where the winner comes in. So in this new table here is you can write in the company names of all the competitors of this company. And then you simply on the internet find some of these numbers that you see in that table. And once you've filled out the whole table for the company and all their competitors, you then look at, okay, which company is doing best in all of these categories. And the company that is doing the best is the winner. And maybe it is not the company you initially thought was super awesome. Maybe it's one of their competitors. And that's when you have to decide, do I want to start from scratch, or do I want to continue with the competitor and actually look into the competitor? Because you're not going to continue with this company if it's not the winner. If it shares first place with another business, you can continue. But we're not going to invest in something that's not a winner. So again, a story from my own life. I've actually been in a situation where I started filling out this with a company that I thought, super cool company, loved to shop in their stores. And then I fill out this diagram and I found out it's one of their competitors, and those stores weren't as nice to actually visit. But I started researching the company and I found out it had the most awesome female CEO that really loved her job and did so much good for her employees, had so many programs to help them grow, and did so much good in the world. So even though my first initial thought was, their stores, they aren't as nice as this one I really like, I actually just found out it was a much better company and really with an awesome team. But yeah, as mentioned, if your company is not the winner, then you have to say bye, and you have to stop your research with that company and either start over again or continue with another company in that industry that did better. So here in the last one here, you just write, yes, check mark, it is the winner, and this is what I found out. And then you write that. These days, I'm watching Becoming Warren Buffett on HBO. I'm watching it again. It's a great documentary, and you can find it on HBO. If you're on HBO Nordic, you can go find it there. One of my favorite scenes is this analogy, a baseball analogy. And it's all about this baseball player who only swings the bat when there's a baseball that is in his zone. So he sees ball after ball go by, and he only swings when there's a ball in his zone, and he let everything else pass. And we will do the same with companies. We'll let company after company pass until that perfect swing that is in our sweet spot. If it's not a winner, it's not a company we're going to invest in. And there are plenty of companies out there. So we'll move on to the next company. And if that's a winner, then congratulations. We're going to move on to the next thing, which is the valuation, the margin of safety, the buying at a sale in the checklist here. So buying a stock in a company means, again, that you own a part of that company. And if we had to buy the entire company today, what would it cost? As a value investor, we want to know what the company is worth, and we want to know this intrinsic value of the company. The intrinsic value is what it is really worth. All the machines, the properties, everything they have what is it worth. But once we found that overall value, we're actually not done, because we want to buy it at a lower price than what the company is worth. And you can actually do that at times. We want to buy stocks on sale, and we call that buying at a margin of safety. Warren Buffett says the three most important words in investing are margin of safety. So when can you buy companies on sale? And that is a good question. Sorry, I just lost it here. First, I want to share with you how you can calculate the price. And I want to talk about valuation methods. To find the value of business, there's many different valuation methods. And there's something called owner's earnings, discounted cash flow. There's different price earnings methods. And all of these words sound super fancy. In my investing course, I have this spreadsheet that will do all the calculations for you. And during the course, I'll tell you exactly which numbers you have to put in, explain it all, and the formulas in this will calculate all the numbers for you. And there's the discounted cash flow, for example. So it is a really awesome tool. And I just want to share, because one of the past clients I've had, Colin, he was relatively new to value investing, and he contacted me on Instagram and asked if I could help him, because he was new to value investing and really needed some more information. So with these valuation models, he have so much more confidence into finding wonderful companies to invest in and determine this value and invest in a margin of safety price. So that is just absolutely awesome. Congratulations, Colin, for not only investing in yourself and in a course, but actually applying what you learned. That is just so awesome. The valuation model I'll share with you today is known from Benjamin Graham, who was the founder of value investing, and he was Warren Buffett's teacher. And this is the easiest and quickest way to calculate a fair number. So I'm going to introduce another expression, another fancy financial expression that's called PE ratio, the price earnings ratio. And that shows the price of the stock compared to the earnings of the business. So how well the business is doing versus the stock price. So we want to find the 5-year PE ratio. And for some stocks, a lot of stocks, you can go to macrotrends.net. And on macrotrends, you find this overview that I'm sharing on the screen right now over here, where the lowest one is the PE ratio. So this is Google. And it is just an example. We don't know if Google is a wonderful business. You'll have to study it first. But their highest PE ratio they ever had was back in 2017. And at that time, it was trading at a PE ratio of 58.52. So we want to take 40% of 58.52, and that is 23.4. And if we look at the graph here, this is an area where it then reaches down to 23.4, which means that we could have bought Google, the stock, from around June 2019, where it was 21.86, so even lower, which is great. And then all the way until March in 2020, so for almost a year. And now, as you can see, it's over our margin of safety price again. So what you can do is, well, first of all, you need to write here in your checklist the 40% of the highest PE ratio. So you write that number, and for Google, we would write 23.4. And then this is not the stock price, right? We're talking about the PE ratio. So how do you actually find that? And if we take Google, for example, I have the Apple stock app here, which some of you might know. This number is many places. Let me just not share, because then it might be easier for you to see. So this is the stock app, and we have Google right here, and PE 25.6 today. You can't really see it, but I'm telling you, check the Apple app or any, Google PE, Google, and you can see the current price. So what you would have to do with this valuation model, you would have to track the price earnings ratio. In my course, I have a calculation so you can get the actual price. So you don't have to monitor the PE, but you can simply just find price. And I give you 3 different prices where once it hits that price, you're ready to invest in this stock with a margin of safety. One thing I want to share now, I told you about this PE strategy here, but please be aware you can't use it for stocks that you heard about in the news or that you found on Reddit or any other group on social media that you heard about from your neighbor or at work. You should only use this valuation for what I taught you today. It only works, the strategy, for investments where we research the company, understand the business and their intrinsic value, and that the company is a winner. Because if you don't do, the price won't tell you what the company is actually worth. So my next topic is when you can buy at a margin of safety. So I'm talking about this sale, but when does this sale happen? And sometimes the stock market as a whole crash. Stocks go down like an elevator, but that doesn't mean that every single business in the stock market from one day to the other is worth less. The company's intrinsic value, it might be the same. The property price, the price of the buildings are the same, the machines, etc. Everything is the same. It's not impacted by the stock market crash. And that is when you can go shopping on a sale. Great companies go on sale. And it is usually also quite emotional. You should know that, because once everything is read, you're like, oh, do I really want to invest? And what you do is you go back to your checklist and you check everything you wrote down. And please do additional notes. Don't just keep within the 3 lines here. Take some notes and revisit and read it again, and it'll create that certainty. I did my due diligence. So even though everything is red around you and everybody's panicking, you're taking a deep breath and you're keeping cool and you're checking back to your checklist. And you're checking that the price you calculated, that's correct, and that you're ready to go in. For me, once there's a sale, I go in big. I know in advance, I've already thought about how much of my savings I want to enter this individual stock with. So I already know that. And then I go in big. So you can do that too. And right now is actually the perfect time to do this case because stocks across the board are overvalued these days. You saw here that Google is overvalued. And you might have heard that the stock market is in a bad shape these days, but it's not in such a bad shape that a lot of businesses have gone on sale. Some definitely have, but not all of them. And that's where you can use these techniques. So again, now is the perfect time to start looking into a company and going through the checklist, using the circle of competence exercise, and just get started building your case. So you're ready for when your wonderful business go on sale and you can check your checklist and everything is good. So the last thing on the checklist here is what is called inversion. Because with that, you want to ensure that you're not in love with your company. No company is perfect, so make sure you spend time to look into the company and look through it through a critical lens. And one exercise you can do is to track back and find out when the stock price actually crashed. And then what happened back then? Was it an overall crash or was it something in the business? And some examples of stock prices falling are, for example, Chipotle, which is an American fast food chain, organic, delicious Mexican food. They're also in Germany. And years ago, on 2 separate occasions, some of their customers got sick from E. coli, which is not that good. But what happened was that the company came back stronger. They improved their processes. They changed things in the business. And it was all forgotten shortly after. Nobody could remember about this E. coli instance, and they went back to the restaurant. And we've seen the same in Danish restaurants, that people have a really short span where they actually remember what has been happening. So again, make sure to just track a little bit back. Another question on the checklist is if the company, if the industry that they're in has gone down in the past, or some of their competitors have gone under in the past, what happened? You can read about it on Google. There are many groups that shares this. So you can learn from these mistakes and then make sure that you monitor that your company is not in that situation. The last thing is if the company will be redundant in the future. If there's not a need, like I talked about the car industry earlier, what are the risks in this industry? You also want to ask yourself if the company appeals to you because of a personal preference that might be clouding your judgment. And we all, know that sometimes we just love a product so much that it can kind of cloud our judgment sometimes. Chocolate, for example, for my part. So make sure to take that step back and try to look through this company through a critical lens, because the next step, and this is where it's okay to fall in love with this company again, because here you have to write down, with these risks in mind, with these risks I found, this is why I still believe in this company. So once you have all of this, it gives you that certainty and you understand what happened for that company. What did they do to bounce back? So our time is up and I have so much more to share with you, and I'd love the opportunity to continue sharing my knowledge about value investing for you. So remember, if you're interested, I have this deal with the 5-week workshop. So as a value investor, we want to invest in businesses that we want to own forever. And this is unlike any other trading strategy where some might use technical indicators and others buy a stock and wait and hope and pray, maybe panic sell or panic buy at the wrong time. So this is different than any of that, because whether the market is up or down, you have a set strategy and you know when to buy, and you even buy when the market is down. That's when you enter, and you sell when it is up. I have been there where I invested and thought I was the right thing. So I'm no better than anyone. But I'm super happy that today I have this strategy, and I'm so happy that you wanted to listen to me for this hour here where I shared all of this, and I hope that you got so much out of it. I did not hold any information back. So what I want you to do now is I want you to take action, because one thing is that now you spend an hour with me, but do the circle of competence exercise right after this call. Draw your circles and start writing some brand names, and maybe even open my checklist and take a look at it. Do an action after this. This course was just the first step. So I hope that you got a lot out of it, and that you'll start using my checklist, and you find that over time you can add some items to the checklist. In this webinar, I might have given you a few pointers that you could add. It's really a living document, and you can grow over time. So with that, I want to say thank you so much, and I hope you found value in this session. I really appreciate that you showed up. Big congratulations to you for making yourself financially literate. I really appreciate it. So thank you so much. I hope to see you again. I have social media channels. I hope to see you there or in my investing course. Take care. Good night.